In this video, I will be talking about the fair value option and investment impairment. In previous videos, we talked about instances where fair value accounting is required, but US GAAP also provides the option to elect to use fair value for most financial instruments. The option is elected on an instrument-by-instrument basis, must be made on the date of purchase or assumption, and the company cannot change their mind later. Hashtag fair value for life. Anyways, when a company elects to use the fair value option, then fair value adjustments will be made directly to the investment account rather than through the fair value adjustment account. Changes in fair value are recorded through net income, not OCI, when the fair value option is elected. The last investment topic we will be covering is impairment. At each reporting date, a company needs to evaluate whether any of its investments are impaired. For example, if we believe that a company that issued one of our debt securities is in financial trouble, we could have reason to believe we will not be able to realize the full value of our investment because they could go bankrupt before fulfilling their contractual obligations. How we account for an impairment depends upon whether the investment is classified as held to maturity or available for sale. Any loss in value for trading securities is already recognized in income, so taking an impairment loss is not necessary. For both held to maturity and available for sale securities, the debit is an impairment loss. For held to maturity, the credit is a direct write-off to the debit securities account. But for available for sale, the credit is to an allowance account. Let's take a look at the example. In this example, Hager Corporation has municipal bonds classified as held to maturity at December 31st of 2017. These bonds have a par value of $800,000, an amortized cost of $800,000, and a fair value of $720,000. The company believes that impairment accounting is now appropriate for these bonds. Prepare the journal entry to recognize the impairment. Okay, so just to take a little look here, if they have a par value of $800,000, that means their face value is $800,000. That's our principal we're expecting back at the end. If they have an amortized cost of $800,000, that means that they were issued at par. We don't have a premium or discount that we're dealing with at this point. And a fair value of $720,000. So for some reason, we believe we're not going to get all of our contractual obligations, so our amortized cost is overstating the value of these bonds. So the journal entry to recognize the impairment. The debit is always going to be a loss on impairment. As soon as we know we have an impairment, we're going to take a hit to our income statement for the amount of the impairment. Now, we're going to impair it down to its fair value. So our amortized cost is the amount that it's on our balance sheet for right now. That's $800,000. We think it should only be on our balance sheet for $720,000. So we're going to write it down $80,000. Now, our credit account is either going to be directly to our debt investments account or it's going to be an allowance account. So this is going to depend on management's intent. In this case, management's intent is to hold to maturity. So that means that if we believe this impairment is going to happen and we're going to hold these to their maturity, then we are definitely going to incur this loss. So we should write it off directly to our debt investments account. If our investment is available for sale, we might get out before the loss hits us, so we're allowed to use an allowance account. Okay, for Part B, what is the new cost basis of the municipal bonds? Given that the maturity value of the bonds is $800,000, should Hager Corporation amortize the difference between the carrying amount and the maturity value over the life of the bonds? So essentially what it's saying here is our face value or par value is $800,000. And before we made this adjustment, our asset on our books was also $800,000, so there was nothing to amortize. We weren't trying to get our asset account to match that face value because it already did. Now we're saying we just adjusted our asset account to $720,000. So we've created a difference between our balance sheet and the face value of our debt instrument. And normally when that happens, we amortize the difference so that at the end of the contractual life, our asset is equal to that face value. So the question is, should we amortize this difference? And the answer is no, because when we took this impairment, what we were saying is that we were saying there wouldn't be, that we're not really going to get that $800,000. So it doesn't make sense to over time slowly write this account back up to an $800,000 we don't believe we're going to get. Okay, finally, at December 31st of 2018, the fair value of the municipal bonds is $760,000. Prepare the entry, if any, to record this information. So now what they're saying is we wrote these down to $720,000, but the new information seems to indicate that the fair value is really $760,000. We wrote it down farther than maybe we should have. Unfortunately, US GAAP doesn't give us any way to write things back up after we've impaired them. So we wrote this down. We believe there was no chance we were going to get more than $720,000. And so now if we do get $760,000, that's just kind of bonus at the end, but we do not get to write it back up on our balance sheet. This concludes our lecture on the fair value option and investment impairment. Don't forget to email your questions for our discussion.